In the most recent quarter, iPhone represented more than 49% of Apple's total revenues. With macroeconomic uncertainties, some analysts have differing opinions on the value of Apple stock. In this video, stocks about to go insane, Apple stock overvalued. Let's bring you all you need to know about Apple tech stocks. One of the main arguments analysts have raised is AAPL's elevated price-to-earnings ratio, which is a company's price ratio to the company's earnings per share. When the original iPad was launched, the tech company experienced fluctuating prices for their P/E between 10 and 20 times for a few years. This persisted until 2019, when the valuation multiple went as high as 44 times and settled at 30 times in 2021. Apple's iPhone X garnered so much success, and with the company's cash return policy, it expanded its business model and services tremendously. Tech companies like Apple tend to command high PEs, and PEs are a way of determining the value of a stock by dividing its stock price per share by its earnings per share. This indicates to investors that a company's stock is realistically valued. Looking at the broad market multiple, Apple's PE is considerably higher, about 27 times. Apple stock is relatively overvalued per their PE calculations. The company has kept an impressive track record over the years. This is why it still stands as one of the most trustworthy stocks. In a bit, we'll give you more details on another reason why Apple stock is overvalued. Remember that this video is never considered a professional financial advisor resource or financial advice for investment. Diligently do your research before investing. If you have followed the news carefully, you would know that Apple stock has outperformed predictions, although the reports on other tech stocks could have been more impressive.
You actually call Apple, quote, the most overpriced tech stock that exists. Tell us why.
Yeah, I mean, in terms of big cap tech, it clearly is in my mind, because if you look at it in terms of how much they're growing relative to the multiple, it just doesn't make any sense, right, relative to the other mega caps. So Apple's revenues compounded over the last 5 years, including this calendar year, because we only have about a quarter left, is growing about 11%. Microsoft is growing about 15% over this time. Google's at 23, Netflix is at 27. Amazon's at 28, and Facebook, given all the discussion about the metaverse, they've grown revenues compounded at 34%. Well, you can buy both Facebook and Google at a lower multiple than Apple. And don't forget, Apple's a massive pandemic beneficiary. And so for them, their iPhone revenues over the last 5 years, fiscal 15 to fiscal 20, were down 11% over 5 years before you had this pandemic benefit.
Despite a drop in iPhone sales compared to previous years, Apple continues to record considerable gains in income, partly due to iMac sales and the openness of China. The company generated $90.1 billion for the quarter, beating analyst consensus by $1.37 billion. The fiscal quarter overall was solid, except for some parts of the market that expected management to provide clear guidance during the holiday quarter.
Nice.
Now, onto the balance sheet. Since it started trading publicly on the market, Apple shares have performed exceptionally well in the market. With a solid balance sheet and investments totaling $179 billion approximately, the tech company has the upper hand in handling its debt and liabilities. Apple had liabilities of $127 billion due within a year, and $155.8 billion coming afterward. Cash available was also $51 billion and $45 billion, meaning liabilities outweigh the sum of its cash and receivables. It is unlikely that liabilities will be a major threat to the company because of its very impressive $2.38 trillion worth of sales. Although the balance sheet should be continually monitored, it is safe to assume that it is quite impenetrable for now. The factors affecting Apple's earnings and the strong balance sheet so far are affecting all stocks in general, especially in current times. What are we talking about? Let's find out shortly, after you subscribe to this channel for more news and stock update. There are speculations that Apple products in 2023 will slow down on currency problems and inflation.
I see.
Disappointing earnings from various tech stocks like Microsoft and Alphabet indicate that the broader market may be greatly affected. Since tech stocks give significant clues about where the economy and prices are headed, the sector will likely slow down in 2023. Some analysts are also quite bullish, stating that inflationary pressures are likely to ease up in the upcoming year. Do you agree? Tell us what you think in the comment section down below. Can we generally speculate that tech stocks will soon pick up where they left off? Macro uncertainties have indeed made the market uncertain for investors. Wedbush analyst Dan Ives said, We compare negative investor sentiment on tech today to what we have seen only 2 other times in our decades of covering tech stocks, 2008 and 2001. Investors fret about the economy and the negative fundamentals affecting the tech stock space.
Noted.
With the economic cycling, valuation levels are likely to drift lower. Although earnings are currently strong enough, demand for products is expected to go down, affecting the stock valuation. Hardware sales and services will also likely decline as consumers deal with a strong dollar. Amid a weak economy, digital advertising and gaming demand should also be significantly affected. Although Apple management has yet to provide guidance for the December quarter, the iPhone segment is set to lead the way with growth and offset the iPad and iMac declines. Apple stock may be overvalued, but with the current global crisis, you should know when to make a move. Check out our video titled When to Buy the Dips on Apple Stock, Apple Stock Analysis for more. Thanks for watching.